Let's get into a little flatbed lane analysis today. And again, this is This Week in Freight powered by DAT, you guys. We do this 3 times a week, drive in, reefer, flatbed. This is a 100% viewer submitted segment. If you're out there and you're maybe in a new market, or maybe you've never seen a tight capacity market before and rising fuel prices and everything else, and you're like, how do I even go about this? That's what this is designed for, you guys. I've seen everything that we're seeing right now, like multiple times in my career. And we're just here to talk about the so what factor, right? Because things change. And we're going to talk about how do we find those consistencies. So this one is Charlotte, North Carolina to Tulsa, Oklahoma. And I personally love shipping stuff into Oklahoma because like there's a ton of freight that comes out of Oklahoma. So it's a great market to send freight into. But again, every time I'm looking at a lane, I always look at the miles first because transit times matter, especially with pricing when it comes down to the weekend runs, right? So again, this is one of those ones. It's 1,000 miles. It's a solid one, right? But a lot of people like to hit that 1,500-mile plus mark on the weekend. So again, you could see a slight rise in rates around that time. But again, that's one of those situations where you kind of eat that cost when you're going in there and working with people pretty consistently. But, again, this lane shows a lot of stability, right? Like, yeah, there's a spike right now where it's up to, almost $3,400 on this. The 1 year mark is 28. And you can make that direct correlation into fuel prices. That's where I see a lot of this because that spike goes right in line when fuel prices rose out there. But I would, again, and this is what I want a lot of us to pay attention to, because if you looked at this line graph down here, and you at this time, and you save this and screenshot this, remove the price from this. All right. I want you guys to pay attention to the trend line on when rates tend to spike and drop back down. And you can start reading these markets for what they are, because yes, there could potentially 1 year from now be a higher price point across there. But I pay attention to the trend line because the trend line more often than not remains the same, okay? Because peak seasonality happens on every lane, regardless if fuel prices are up, down, capacity's up or down. There's very few times where there's like drastic spikes that there isn't an anomaly or an event that you can point to and say, this happened during that time frame, i.e., anytime there's a major winter storm, major weather event, wildfire shutting down freeways, stuff like that. So it's like, we got to look at when we're pricing freight on the long term with our customers, it's not as complex as a lot of people want to make it out to be. The free market's the free market, and eventually people will pay for that product to be shipped out, regardless of what the price be. Obviously, I'm not saying go in there and bid $1 billion or anything like that. But the trend line is what you need to pay attention to, because yeah, it could be at $3,400 throughout the entire year. And that's, exponentially higher than some of those other things, but I guarantee the market performs the same. Now, what could happen is it could continue to rise out there. And if capacity continues to leave the market, that could have a pricing effect on it, right? Just like with diesel right now. And we're going to break this down in one of the articles here. It's going to be interesting to see what happens to pricing now that the Strait of Hormuz is back open here, at least tentatively for the next 15 days or so, what that can do out there. But, I bring this stuff up, you guys, because a lot of these lanes don't change as much as a lot of people want you to think. There's a lot more stability out there than you think in these freight markets. It just might cost a little bit more because, frankly, that is the free market. And it's our job to be able to read this, go to our customers and let them know. And, at times you need to be prepared to maybe see a dip in your volume out there, because there are going to be people right now. I don't know how they're going to be able to afford to do this, who are going to continue to bid super low. They're going to break even, lose money. But eventually the service failures start to creep in there. But this lane, I think the spike that you see right now, if you got, I would say that this lane is going to be pretty stable here, because again, I look at the outbound market as well. Oklahoma is a good outbound market for flatbeds. And it's going to probably perform the same if you follow this trend line. It just looks like the new baseline that were out there is going to be sitting around that 3,300 mark. And to me, it looks like it's a direct correlation to fuel pricing out there. But that is This Week in Freight, you guys, powered by my friends over at DAT. They are the official data partner of the Freight Coach podcast. That lane was Charlotte, North Carolina to Tulsa, Oklahoma. And again, if you want your specific lane broken down on the show, email my team, podcasts@thefreightcoach.com. I just need a shipper city, delivery city, and trailer type.